Charles Lemonitis. At ValueWorks, you really dig into the footnotes to find stocks you like. One stock you're quite bullish on is Xerox. Now they're transitioning away from the document business. Tell me what you like about Xerox.
Xerox has done a great job of taking their historic strength in document management and building a business in services. The services side of their business is now more than half of the top line and is going to be an important contributor to $1 plus a share worth of earnings. Stock's trading inside of $8, so that's inside of 8 times earnings. The growth side of the business, the services side, is going to be bigger than the document management side by degrees, by year over year, and you're going to have a big earnings grower and an 8-time multiple.
You're also bullish on Nokia. I think you're one of the few people who are bullish on Nokia. What do you like about this player?
Yeah, the stock has suffered for a lifetime and a half, and perhaps rightly so. Still, what we like about it is the fact that the debt trades at a 10% yield and 75 cents on the dollar. The company has more cash than debt by a factor of almost 2 to 1. People are worried about the metrics there because the smartphone transition is tough, but they're doing a fine job in terms of holding on to their cash. They didn't lose a lot in this last quarter. And they've got more than 2 times the amount of cash than they do debt, and the debt's trading at 75 cents on the dollar. So I think it's a real easy one.
All right. When you dig into the footnotes and the financial reports of Eli Lilly, what do you like there? Because people are worried about the pipeline. People are worried about Obamacare. Why aren't you worried?
The nice thing about Eli Lilly is that it's great value hiding, I think, in plain sight. The story there is there's been a patent cliff. They've gone off that patent cliff. Earnings are now stabilized at a lower level, but that lower level is going to be, at $4 a share within a year and a half from now as a run rate. And the stock's trading at $44 a share. If you look at big cap pharma, there's been a rotation into this group over the past 6 months, a year. These stocks are powering higher even though there's no important fundamental developments. I think what's happened is that there's been a gestation period where the stocks have grown into their equity caps over the past 12 years, and you're likely going to see a step function higher for these shares over the next 12 months. They're 44. I think you'll see them at 55 12 months out.
Finally, you choose stocks from the bottom up. You're a fundamental stock picker. However, when you look at the top down, our economy is slowing. China's slowing. So why do you want to own a stock like Dow Chemical in this environment?
Well, another thing that's happening top down is input costs for the chemical companies, and particularly Dow Chemical, are plummeting. One of the biggest input costs for chemical companies in Dow in particular is natural gas. If you look at what's the biggest transformation in the U.S. economy over the past 5 years, I would argue is that fracking has led to natural gas prices that are going to stay at $3–3.50 an MCF for as far as the eye can see. That's allowing Dow to lower their input costs, and we'll see earnings growth. They're earning about $3.50 this year. That's going to grow, consistently for the next 2 years. You can see $7 a share worth of earnings out of that company 2 years down the road, and the stock trades in the low 30s.
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to